Welcome, everyone. Today we are diving into the fascinating world of futures market chart patterns. We are going to break down what these patterns are and, more importantly, how to use them to understand the market better and make smarter trading decisions. The futures market moves really fast, and if you know how to recognize these patterns, you will have a big edge in finding opportunities. No matter if you are brand new to futures or have been trading for a while, by the end of this session, you will be able to identify these patterns with confidence and use them to make informed choices. Stick with me because we are about to uncover some powerful strategies that will keep you ahead in this fast-paced futures market. Whether you are here to sharpen your skills or discover something completely new, you will not want to miss what is coming next. Now let us start by talking about what futures market chart patterns actually are and why they matter. These chart patterns are recurring shapes that appear on price charts, and they are created by the way prices move over time. Think of them as visual signals that can help traders predict what might happen next. If you understand these shapes, you can get an early indication of possible price movements based on how prices have behaved in the past. Patterns like these include trends, reversals, consolidations, and breakouts, each providing different insights into market behavior. This is especially helpful in the fast-paced futures market where price changes can happen very quickly. Recognizing these patterns can help you decide when to enter or exit a trade, manage your risk better, and make more informed trading decisions. The futures market is quite different from other markets, such as the stock or forex markets, in several important ways. Let us dive into these differences to better understand what makes futures unique and exciting. One of the biggest differences is leverage. Futures markets provide much higher leverage compared to other markets, which means that even a small price movement can lead to significant profits or losses. This leverage makes the rewards enticing, but it also makes managing risk absolutely critical. In the stock market, you might buy shares outright with only a limited margin available. In futures, however, a small deposit can control a much larger position, which adds to both the potential reward and risk. The speed of price movements is another key factor. In the futures market, price changes happen much more quickly than in traditional stock trading, where prices tend to move more slowly and steadily. Futures traders need to be on their toes, ready to act at a moment's notice. In contrast, the stock market often allows traders more time to consider their options. The forex market, on the other hand, can also be fast-moving, but it typically lacks the same kind of leverage that futures offer. This rapid movement in futures markets means traders have to be alert, sharp, and able to recognize patterns instantly to take advantage of opportunities. Additionally, futures markets are highly influenced by macroeconomic factors such as global supply and demand, interest rates, weather conditions, and geopolitical events. For example, crude oil futures can swing based on political tensions in oil-producing regions, while agricultural futures respond to weather forecasts. This is different from the stock market, which tends to be more affected by company earnings reports, business performance, and investor sentiment. The forex market, meanwhile, is largely driven by changes in interest rates and global monetary policy. This diverse range of influences means that futures traders must be aware of a wide variety of factors that can cause sudden volatility. Because of the fast and volatile nature of the futures market, knowing how to read chart patterns is crucial. These patterns provide insight into where prices might be headed next. In the stock market, a head and shoulders pattern might take weeks or even months to fully form, giving traders ample time to analyze it. In the futures market, however, these patterns can develop within days or even hours, demanding quick recognition and swift action. The forex market often lies somewhere in between, with patterns that can also form quickly but might not have the same level of leverage impact as futures. If you are trying to ride a trend or catch a reversal, being able to identify these patterns quickly in the futures market, it is key to staying ahead. This fast-paced environment rewards those who can think and act decisively. Let us explore a real-life example from the crude oil futures market. Here is a well-known pattern called head and shoulders that showed up in crude oil futures. Picture this: there is an uptrend and then three peaks form. The middle peak is the highest and it forms what we call the head. The other two peaks, one on each side, are the shoulders. Now, the important part here is the neckline. This is a line that connects the low points between these peaks. The head and shoulders pattern is used by traders to identify a potential trend reversal. When the price breaks below the neckline, it often indicates that the previous uptrend is coming to an end and a downtrend might begin. This is why it is considered a bearish reversal pattern. Traders will often use this pattern to time their entries for short positions or to exit long positions before the price drops further. The key to effectively using the head and shoulders pattern is to wait for the price to break below the neckline with strong volume. This volume confirmation adds weight to the signal and reduces the chances of a false breakout. In comparison to other markets, the head and shoulders pattern in futures often forms more quickly due to the higher volatility. For instance, in the stock market, the same pattern might take several weeks or even months to fully develop, but in the futures market, especially with commodities like crude oil, these patterns can emerge and complete within days. This rapid formation requires traders to be especially attentive and ready to act when they see the pattern developing. One of the pros of using the head and shoulders pattern in the futures market is that it provides a clear signal for a potential trend reversal, allowing traders to capitalize on changing market conditions. The quick formation in futures means that traders can potentially enter and exit positions faster, taking advantage of swift price movements. Additionally, the head and shoulders pattern often offers clear levels for setting entry, exit, and stop-loss points, which makes managing risk more straightforward. However, the speed at which these patterns form in the futures market can also be a drawback. Due to the high volatility, there is a greater risk of false breakouts, where the price appears to break below the neckline but then reverses direction. This makes it essential for traders to wait for volume confirmation to reduce the chances of getting caught in a fake move. Moreover, the rapid development means there is less time to analyze and verify the pattern, requiring traders to be highly disciplined and experienced in identifying valid setups. Another con is that relying too heavily on a single pattern, like the head and shoulders, can sometimes lead to missed opportunities or increased risk, especially if broader market conditions are not taken into account. It is important to use the head and shoulders pattern in combination with other technical tools and fundamental analysis to improve the accuracy of trade decisions. Another important aspect of using the head and shoulders pattern is the placement of stop-loss orders. Traders typically place stop-losses just above the right shoulder to protect against false breakouts. Additionally, they can use the height of the head to the neckline to estimate the potential price move after the breakout. For example, if the distance from the head to the neckline is 10 points, traders may expect a similar 10-point move after the neckline is broken. Overall, the head and shoulders pattern is a powerful tool in a trader's arsenal, especially in the futures market where price action can be swift and significant. Properly recognizing and confirming this pattern can provide clear opportunities for profitable trades while managing risk effectively. The crucial moment comes when the price falls below that neckline. When that happens, it is a strong sign that a reversal is about to take place. And in this case, crude oil futures reversed sharply. This was a clear signal for traders to consider a shorting opportunity. What should you remember from this example? When it comes to futures, a head and shoulders pattern can be a powerful signal that prices are going to change direction, especially when you see a lot of volume as the price breaks through the neckline. Let us keep going and explore the next pattern. Now let us move on to another pattern, one called the ascending triangle. This time we are looking at an example from the S&P 500 emini futures market. Imagine a pattern where the price keeps hitting the same resistance level at the top, but the lows keep getting higher. It is like the price is being squeezed upward until, finally, it breaks through that top level. In the case of the S&P 500 emini futures, after bouncing off that resistance level several times, the price finally broke through and made a strong move upward. This is the kind of setup that can lead to a powerful bullish move, especially when you see an increase in volume. The takeaway here is that an ascending triangle often signals a big upward move. It is especially effective if the breakout is confirmed by more trading volume. This pattern is a great one to watch for if you are looking for bullish opportunities. Next up, let us talk about a pattern that signals a continuation of a downtrend. This one is called the bear flag. We saw a bear flag form in the gold futures market, and it is a great example of how this pattern works. A bear flag happens when there is a sharp move down, followed by a period where the price moves sideways or even slightly up. This consolidation phase forms the flag, while the initial sharp move down is referred to as the flagpole. The bear flag is essentially a pause in a downtrend before the trend resumes. Once the price breaks down from the flag, it signals that the downtrend is continuing and often leads to further downside momentum. Traders use the bear flag to identify opportunities to enter a short position during a downtrend, allowing them to catch the continuation of the bearish move. The key to effectively using the bear flag pattern is patience. Traders wait for a confirmed breakdown below the flag with strong volume before taking action. Volume is critical because it indicates the strength of the move. When volume increases as the price breaks down, it suggests that sellers are taking control and the continuation of the downtrend is more likely. Another important consideration for traders using the bear flag pattern is the placement of stop-loss orders. Typically, stop-losses are placed above the top of the flag to protect against a false breakdown, which can happen if the price temporarily moves upward before resuming the downward trend. Traders often use the length of the flagpole to estimate the potential move after the breakdown. For example, if the flagpole measures 20 points, a trader may expect the price to drop another 20 points once the flag breaks down. In comparison to other markets, bear flags in the futures market can form and resolve much faster due to the inherent volatility. In the stock market, a bear flag might take several days or even weeks to develop, while in the futures market, such as with gold or crude oil, these patterns can form within hours or even minutes. This speed requires futures traders to be vigilant and prepared to act quickly. The bear flag is a powerful pattern for traders who prefer to trade with the prevailing trend, as it provides an opportunity to capitalize on the continuation of an existing downtrend. Properly identifying and confirming this pattern can lead to well-timed entries and profitable trades while managing risk effectively. In the case of gold futures, after moving sideways for a bit, the price broke down again and the downtrend continued. This gave traders a chance to profit from the ongoing bearish move. Bear flags are strong continuation signals, and in futures markets, they give you another opportunity to enter the downtrend after the price takes a brief pause. Let us move on to yet another type of pattern. This one is called the symmetrical triangle. In the natural gas futures market, we saw a symmetrical triangle form, and it is a pattern that shows indecision in the market. With a symmetrical triangle, the price makes lower highs and higher lows, forming a shape like a triangle. The price is getting squeezed tighter and tighter, and no one side is really in control. The key moment comes when the price finally breaks out, and it can break in either direction. For natural gas futures, the breakout came to the upside, and after several weeks of squeezing, the price surged. What should you remember here? With symmetrical triangles, always wait for a clear breakout before making a move because it could go either way. Once that breakout happens, though, it is often a strong move. Next, let us look at a common reversal pattern called the double top. This example is from the Euro futures market. Imagine the price going up and then hitting a resistance level, dropping down, and then trying to go back up to that same level again, but failing. That is a double top. It signals that the uptrend is likely over and the price might start going down. The key is when the price breaks below the support level between the two tops. In our Euro futures example, after failing to break through that resistance twice, the price dropped sharply. The double top was confirmed, and the reversal led to a significant bearish move. The lesson here is that double tops are powerful signals of a reversal, and once the price confirms the pattern, it can lead to a big change. When you see this in a futures market, it is often a sign that the trend is turning. Now that we have walked through these examples, let us talk about some key factors to think about when you are analyzing futures market chart patterns. The first thing is volume. In futures trading, volume is really important. It confirms the strength of a breakout or breakdown. If the volume is high when the pattern completes, that is a good sign that the move is strong. If the volume is low, the move might not hold. Another important thing to consider is the time frame. Futures markets can move fast, so the patterns you see on shorter time frames, like 5-minute or 15-minute charts, can be really helpful for day traders. But do not ignore longer time frames either, because they can show you the bigger picture, which is useful for swing traders. And of course, risk management is key. Futures markets are highly leveraged, which means you can make a lot of money, but you can also lose a lot. Always set stop-loss orders beyond key support or resistance levels to protect yourself. Let us also talk about some common mistakes that traders make when they are looking at these patterns. One mistake is jumping in too soon. It is tempting to make a move before a pattern is complete, but it is important to be patient. Wait until there is a clear breakout or breakdown before you take action. Another mistake is ignoring what is happening in the broader market. Sometimes, even if a pattern looks perfect, external factors can completely change the game. There might be breaking news, such as economic reports, geopolitical events, or changes in government policies that make the market behave differently than expected. For example, an interest rate decision by the central bank can influence bond yields and, in turn, affect futures prices. Or consider a sudden shift in oil supply due to geopolitical tensions that can instantly impact crude oil futures, overriding any technical pattern you might have identified. Always keep an eye on the bigger picture because outside factors can have a big impact on futures prices, and they can often override even the most promising chart patterns. Being aware of the overall market context will help you avoid surprises and make more informed trading decisions. Now that you know how to identify and analyze these patterns, let us talk about some practical steps you can take to start using them. The first step is to focus on learning the most common patterns like triangles, head and shoulders, and flags. These are the foundation for futures trading and will give you a good base to work from. The second step is to practice in a simulated environment. Use a demo account to identify patterns and practice trading without risking real money. This is a great way to build your confidence and get better at spotting patterns in real time. The third step is to track your results thoroughly. Keep a detailed trading journal where you record not only what patterns you see, but also the exact conditions under which they appear. Note the time frame, volume, market conditions, and your emotional state at the time of making the trade. Write down how well these patterns worked out, whether they met your expectations, and what you could do differently next time. This detailed approach will help you learn from both your successful and unsuccessful trades, giving you insight into how to improve your strategy over time. By looking back at your notes, you can identify which setups work best for you and refine your trading plan to focus on your strengths. Let us wrap things up with a quick recap. Futures market chart patterns are all about recognizing the right shapes, confirming them with volume, and using smart risk management. The patterns we talked about today, like head and shoulders, triangles, and flags, are just the beginning. The key is to practice spotting them and always wait for confirmation before you make a move. Remember, mastering these chart patterns takes time, and it is important to stay patient and keep practicing. Once you get the hang of it, you will have a powerful tool for predicting price movements and spotting opportunities. So keep at it, stay confident, and soon you will be able to navigate the futures market like a pro. Thanks for being here today, and good luck with your trading journey. Feel free to share your thoughts and questions. Stay curious and keep